Prior to this event, I think we were already in a recovery in terms of growth. So this event has probably delayed that a bit. My generic view is I think people are overestimating the impact, because that's how the anecdotes come. So it's anecdotal. Indeed, there is a big challenge. We're talking about exchanging $220 billion of cash. It's a mighty amount of money to exchange in a country of the size of India with the population of India. So it can't be done overnight. Therefore, it's going to take time. And as you report this, it's a day-to-day thing for you, right? So you can't fast forward 3 weeks and say how the situation will be. But I think when you look back on this, say a month or two from now, all this chaos of the month of November may seem less relevant, is what I feel. I think that reality is somewhere in the middle. I'm not going to any extreme, okay? I'm not saying it's all hunky-dory and nothing is happening. I'm not saying that, okay? So don't misquote me on this. Of course there is impact, and the impact is surely negative in the short run. But I don't think it is as large a negative impact as is being made out by people. Where I think I've seen some people talk about, a recession in the economy. I don't think it's that bad. Yes, India is a cash-intensive economy. Let's not make any mistake about it. 13% of GDP is circulating as cash. Okay? Not all of it. In fact, bulk of it is not black money. Bulk of it is transactional cash. All of us transact in cash, right? That's how this economy has been. That's the anchoring of people in this country. They like to deal in cash, right? They don't want electronic. That is why we have only 40 million credit and debit cards in a population of 1.25 billion, right? We don't have 800 million cards, right? So by now, otherwise we would have 800 million cards and nobody would care about this. This is a kind of a shock that the system has got to accelerate its move towards electronic. And if that happens, it will be a huge positive bonanza. I'm not even making that call. It's a possibility. And there is pain in the near term as people get adjusted. To put $220 billion back into the economy is not an overnight affair. It takes time. It will happen over the next 4-5 weeks. And let's revisit this story at the end of December and see where we have reached. I feel that when we look back to the chaos that has been projected or has been painted right now, may look a little exaggerated when we approach the end of December. But we can always circle back and check that. I think the three or four sectors that look the best, one is financials, the other is technology, consumer discretionary, and to some extent industrials. I'll still avoid the defensive sectors like staples and healthcare. Technology is just a pure valuation call. A lot of people ask me the question about what will happen to US visa policy. I'm not making such forecasts. I have no ability to call that. I think it's logical and sensible for the US to continue to support outsourcing to India, because India reduces costs for American corporations and drives their profits higher. So that's a logical thing to do. But more importantly, I think the stocks look very cheap. They're pricing in single-digit earnings growth over the next 5 years, and that looks like an attractive entry point to me. If you look at tech stocks, we just published a chart yesterday. They correlate very positively to change in US bond yields. And I'll explain the rationale behind that. US bond yields will reflect underlying US growth expectations. So when yields are rising in America, it means growth is improving. If US growth is improving, that means US companies will start investing. If they start investing, they will give more contracts to Indian companies. So software revenues will actually start rising. So there's a strong correlation. Now you know what US yields have done. Stocks have actually not reacted. There's a 3-month lag. So in 3 months, people will start realizing that, oh my God, software stocks in India are going to get better revenues now. So I'm actually quite bullish on technology. That's because there has been big outflow from emerging markets. So the selling that has happened in India is just a reflection of the EM outflows. It's not an India-centric issue. So if EM outflows change and they turn into inflows, flows will come back to India. So idiosyncratically, most foreign investors are very bullish on India. So if you look beyond the noise of monthly flows, and if you look at it from a 1 to 2 year perspective, I think it is the flows will continue. I can't precisely tell you whether they return next month or not, because we don't know whether the view on EM changes next month. Don't forget, all the US indices have hit all-time highs 2 days in a row. That last happened in December 1999. Okay. So right now everybody's focus is on the US stock market. So emerging markets are taking a backseat right now. So we'll see, those things change, they keep moving around. There have been a series of moves by the government to arrest the creation of unaccounted wealth, right? So they have renegotiated tax treaties, right? They've tightened up penalties in the tax laws. They've changed procedures. There's been an ongoing electronification of the entire tax system, the linkage of PAN cards to transactions, GST, okay? So when you see the sequence of steps, this becomes an additional step in that sequence which has got great messaging, okay? But it's not as potent as GST in terms of its ability to reduce unaccounted wealth. I'll explain why. So imagine in GST, you are a producer of a good and you don't pay tax, correct? So which means mota you are saving 25% tax, because that's the average rate of tax in the country on indirects, on an indirect basis, right? Suppose your margin is 10%, right? So you're outside the tax net, so you're saving 3.5% in terms of income tax. So where is 3.5% versus 25%? So that is the magnitude of impact. So this event is 1/10 the size of the GST event. If GST were to increase accountability of the system by 10, this will increase accountability of the system by about 1. So that's the equivalent impact. So it's not to say that this is not important. It's one of the many steps that the Narendra Modi government has taken right from the beginning. So it did not start yesterday. From 2014, they've been taking a series of steps. So I think this is very essential from the perspective of cleaning up the system and making India less corrupt, and therefore improving the ease of doing business. So it is in that context, I think it is an important step. But its impact is not as significant as GST. And some of the other things the government has done, which has probably not attracted so much attention because it doesn't have wider public implications, probably were more important in terms of arresting black money creation. To my mind, GST is actually far more significant when it rolls out, and it will have greater implications on unaccounted wealth than this particular move. It was not. It's okay for armchair economists to say that we should have only had 2 rates. So some people have actually told me this also, that your government has bungled, you should have only had 2 rates. I said, okay, you do it for me and show me how you do it without affecting inflation and growth. Karke dikhao na. It's so easy to say that. You have right now there are like 25 rates in the system. You have to subsume all of them into 2 rates without causing major inflation or growth disruption. How can you do it in one shot? I think eventually we will go to a single rate structure in 5-7 years, right? Or a dual rate structure, right? But to do it on day one, I think was physically not possible without causing major damage to the economy. So I don't think that risk is worth taking. Why should you take such risks, right? So you can go step by step. So they have got a few rates. Actually, it's not 4 rates, it's more than 4 rates. Yeah. Because you count zero, you count gold, you count sin goods. So yeah. So there will be 8 or 9 rates. I think there are 10 rates actually. So it'll reduce over time. I think that's a very important point, and it goes back to the debate I was having with Sajid, which is that ultimately the final impact of this will not be known in advance. And we can all make our calls and say, okay, growth is going to sink, this is going to happen. Frankly, I think we'll have to see this at the end of this exercise, which is sometime in January. So you're right, it's not a net 13% of GDP that the banks are receiving in cash, because part of it will go out back as cash. What we will have to see is, in 6 months from now, where does currency in circulation settle at? It was 13% before demonetization was. Does it settle at 11? Does it settle at 9? Or does it settle at 13? And that difference is the net increase in banking penetration. I suspect there will be an increase in banking penetration. There will be an increase in electronic. If you ask me what will be the number, I have no idea. No idea. Is it going to be 2%, 5%? No idea. Or is it going to be 0.5%? I have no idea. But that will be I would say a collateral gain for the system. While everybody is focused on the black money bit, I think this collateral gain is a very big gain that will happen in the system. In the context of India's macro stability, today that risk is less relevant to India. We are pretty comfortable. And in fact, this is the first time in the history of India's liberalized economy. So go back to 1992 when India opened its doors to foreign investors. So in 25 years is the first time India has cut rates against a Fed rate hike. Because remember, the Fed has already hiked in December and we've cut after that. It's never happened before. It is, I think, a manifestation of the strength that India's external balance sheet has. We have never had the courage to go against the Fed in the past. And this has never received any media coverage, I think. I wrote about this, that this is a unique event in Indian history where we have cut rates against a Fed hike, and it's likely that the Fed hikes in December, which is our base call, and our base call is that the RBI will cut in December. So it will happen second time in a matter of few months. So it just demonstrates the strength of our external balance sheet, that we are able to run an independent monetary policy. So that has not happened before. That generation which suffered low equity returns in 90s has gone past. There's a new generation of people looking at stocks, and this new generation has grown up with this education that the best way to build a portfolio is systematically invest at the end of every month rather than trade. So it's a very different approach that people are showing. I don't know if you've seen the SIPS data, but the SIPS data shows a structural trend, which is it's gaining share in flows. So this is not about people trying to time the market. They are actually just putting part of their monthly income into the stock markets. Okay, so demonetization will increase the number of people who own stocks or financial assets to be more generic. I think it's not going to necessarily bring people to stocks, assuming that all of us have bank accounts. But the guys who don't have bank accounts or who are going to get introduced to the banking system are not naturally the ones who are going to first put money into the stock market. They will first put money into a bank deposit. So the benefit will go to the banking system. Saving and savings का difference ये है कि saving is flow, savings is stock. Okay, so when we say savings, we refer to stock. Okay, so today the stock of equity holdings in the household balance sheet is about $300 billion. The flow trailing 12 months is $20 billion, that's saving.